Nick Savas, welcome back to the Roadmap to Retirement podcast, backed by popular demand.
Welcome to Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
This is your second appearance. How does it feel to be here twice?
I am honored.
Okay, that's great.
I cannot wait to be back.
There's only been a couple of repeated guests, so it's a big deal.
Yeah,
people are excited.
I'm excited about this.
Awesome. Today's topic is all about financial planning for young families. So we'll say our listener for this might be a 30-something-year-old couple with a young child at home, which makes you perfect for this because you are a 30-something-year-old with two young children at home.
Yes.
And one on the way. Can I say that in the air?
Yes.
Okay, it's not a secret?
We've already put it out
Perfect.
there, so
all right.
Not a secret anymore.
So soon to be father of three, we're here talking about financial planning for young families. So I thought we'd start with the elephant in the room. I think this is the biggest question that we get about is, how do I save for college for my child? So our generation went to college in a time where we had these heavily inflated tuition rates, and it's only continued down that road. So a lot of our peers, people our age, have these big student loans, or maybe they paid them off. If so, good for them. So parents want to know what they can do to help their kids 18 years from now when they go to college.
Yep.
What do you think? Where do we start?
There's a couple ways to start. I think a lot of this will start with goals and priorities, right? So I guess I'll preface it with this, and then we'll obviously go down the college planning path. But I think a lot of people really, one of their top goals is to save for college, and they might end up realizing that it's not fully attainable, or they're doing it to their own detriment. So one of the balancing acts too that we can always talk about is, how much do I need to save for retirement, but then also college? So there's definitely that balancing act there. But then going down the college path, we take a similar outlook to how we would look at funding someone's retirement to how we would look to fund someone's college. Obviously, we have a much shorter window, right? We're looking at saving for 18 years versus potentially 30, 40, however much it's going to be. So really, I think the first step is looking at what college might potentially cost in the future. Just the same way we would start to outline how much do we think retirement's going to cost in the future. And then we can start to drill down to how much do we actually need to start saving? How do we need to grow that money to get to a point where we can start to make that a reality. And then once we've determined that, there are different types of investment accounts that I'm sure we'll talk about as well, that we can look at as maybe the best ways to start to fund that once we've determined, okay, what's it going to cost? How much do we need to save to get there? What types of accounts should we use? And then we always have to do this in the context of, what's my financial situation? What's my budget? What can I realistically afford to do, right? Do we really want to try to fund 100% of college education? Do we want to, if that's attainable, great. How do we do it? If that's not, or maybe that's just not a family goal to do the whole thing, but maybe we want to do some, right? So that's really where the conversation, I think, starts.
Yeah, I'm glad you brought it up, but let's start with goal setting. So I think one of the things I see all the time is parents tend to have, maybe it's a biological thing where they care more about their child than they care about their own future.
Yep.
So we're all of a sudden, they've got a child, maybe the kid was born yesterday, and it's immediately, how do I save for college for them?
Yeah.
But then it's very quickly turns into you're robbing Peter to pay Paul, and you're to your own detriment. Like you said, you're neglecting your own retirement planning. So one of the big mistakes that I see a lot of young parents make is they're not focused enough on their own retirement planning, and they're all about how to put more money into the 529 or whatever other type of account you're using to save for college.
Yep.
So I think maybe step one is making sure you're taking care of yourself before you even start saving for college. Let's make sure that you can have different goals, but maybe let's make sure we're saving at least 10 or 20% into our own retirement account before we even consider saving for college, because what we say to clients a lot of times is you can save for, or you can borrow for college, but you can't borrow for retirement. So maybe your kid will have to take student loans out, and maybe you don't love that idea, but it might just be the best option for everybody.
Yeah, and we do tell people that, but I do think it's true, because you really can't, right? So if at the end of the day, if your son or daughter wants to go to school, there are means to be able to pay for that now, whether even if it's having to take out debt. those mechanisms don't exist for retirement planning, right? You can't just go to the bank and get a loan to say, hey, I want to retire. So
I might tomorrow. I'm going to try that.
Yeah.
I'll let you know. Next episode, we're going to talk about that.
Yeah, exactly. So the goals and the priorities are first and foremost, and then we can start to plan from there.
Sure. Okay, great. So let's say that in a perfect world, we've addressed our own retirement. We're saving plenty of money there. We have no concern at all about our own ability to retire in the future. And now we want to turn our attention to helping our children.
Yep.
I'm going to tease a little bit further, and we're still going to push the college savings down one more step. I think there's a big elephant in the room that needs to be addressed before you save for college, and that's the insurance world, which is never fun to talk about. None of us like talking about insurance. It gets a bad rep because there are some life insurance sales people out there that call themselves financial advisors, and they might be a little bit too aggressive on this. But the reality is that college savings isn't going to help your family immediately. But in the God forbid scenario that you don't come home for work, the life insurance policy can drastically improve your child's life, even though there's, of course, still a hardship there.
Yeah.
So what are some mistakes that you see people making around life insurance, or is it just as simple as having the conversation?
I think biggest mistakes are, number one, not having the conversation, or I see a lot of people who don't have life insurance. They just might have some through work, and they don't know exactly what it covers.
See, I'm all set mentality, right? I know I have life insurance, therefore I don't need to think about it. So I'm good, check the box. But you need to understand what your coverage is, how much it is, and whether or not that's right for you and your family.
Yeah, so we're going up the building blocks here, right? So we have goals and priorities. Life insurance is designed to replace an income that could potentially be lost by someone passing away. We also want to protect against debts that they might incur, right? So if a spouse passes away, unfortunately, and there's a couple $100,000 still on the mortgage, well, we could earmark for that and have that be wiped out completely, so it's not a financial burden, right? It's already an emotionally tough time. So it's, to your point, not super fun to talk about, but it is one of those things that could have huge devastating impact on a family that would make college planning not even a consideration at that point, right? It really is something that we want to start to talk about first, and it doesn't have to be that expensive. I think that's one of the biggest things out there is there's lots of different types of policies. Again, we want to make sure we have the right amounts in place, which we'll go through an analysis to figure that out. But there's types of policies out there that we could, in different ways that we can fit this stuff into your budget.
I think that's important to know because I see a lot of young couples that come in and they meet with me for the first time and they're like, I met with so-and-so a year or two ago and we talked about life insurance. It's really expensive. And you can do some digging and you learn that they probably met with the wrong type of advisor.
Sure.
And they were pitched a product that was some kind of whole life, universal life, very expensive permanent insurance policy. I'm not going to say that those never make sense, right? But typically a young family, we want some kind of cheap term insurance that's going to cover us from today until our kids are financially independent, whether you say that's 18 years or 30 years, whatever the number is. And to do that, to your point, it doesn't have to be very expensive. So I would encourage young families to look into that and get the coverage that they need for the God forbid scenario and forget about all the other bells and whistles that can go into a more expensive policy.
Yeah, you brought hey, we want to make sure we're saving to our own retirement. We're also going to start to talk about funding college. These savings, if we think about, obviously it's money going out, so those things will start to add up, right? So we have our normal bills, we're trying to save for retirement, we're trying to save for, if we need to implement life insurance just to protect against the worst case scenario, finding something that costs $50 a month is going to be a lot easier to implement than something that's going to cost a few $100s a month, right? So just making sure that it's there, it's peace of mind, it's taken care of, and that allows us to then move on to the next step.
Sure. Okay. One more life insurance question before we move on.
Go ahead.
So how much coverage do you need? And there are different formulas, and you're laughing because you've heard this conversation before, but there are insurance agents out there that'll take your income and multiply it by 20 because that's going to be 20 years of income, or you can kick off 5% per year to replace your income indefinitely, which in my opinion isn't generally the goal. We're not trying to create lifetime payments for the next 80 years. So how would you approach that? I'd like to put some numbers on it to give you an easy example. Let's say we have a couple, their household income is $200,000. For real simplicity, we'll say they each make $100,000 a year. They've got 2 kids at home. How much insurance do they need?
What I like to do is,
It's not perfect,
yeah,
but
it is not, right? But what I like to do is we want to focus on what the take-home pay is. The one thing that people, that we go over with people and people should understand is that the death benefits on life insurance are generally tax-free.
Mhm.
So if you inherited death benefit from a policy, that's $500,000. That's a true $500,000. So in your scenario, right, we have $100,000 each of income. Each spouse is responsible for bringing home the same amount. So let's just say after taxes go out, their contributions to their retirement, their net amount, let's just say, is $5,000 a month. So we really want to focus on that number because that's what's truly coming into the household that's responsible for the month-to-month bills, paying the mortgage, taking care of things, paying for food, groceries, the childcare expenses, all those different types of things. So really what we want to do is assess if that $5,000 that spouse is responsible for is no longer coming into the household. That's obviously a pretty big, that's a massive blow, right? So part of this is conversation we're going to have with the client to say, okay, if we wanted to replace this $5,000 a month, that's $60,000 a year of net income, for how long, right? Do we want to focus on, we have the child dependency years, that's probably the phase that we need to protect the most, where we probably need the most coverage, right? And then things might change after that. So we're going to start to look at the longevity of someone, different phases in their life. We're going to start to look at the amount we need to take home. Some people, we'll look at the 5,000, but maybe if we only needed to replace 4,000 or 3,500 or something, those numbers we'll start to look at too. But that's really how the analysis works, that we'll start to look to determine what that actual number is. And then we'll take into consideration other goals that they have, mortgage, student loans, other debts too, that we'd want to make sure are covered. And then we'll basically put all that together and come up with numbers.
Mm-hmm.
And then we'll go out and look at, hey, if we did all this in a term policy, what does this cost? Look at various insurance companies and get to the numbers from there. But I would say from top to bottom, that's how we would look at it.
Cool. That's not a short answer, but I think it's the right answer.
Yeah.
I guess the take home, or somebody's listening to this, what they really need to know is meet with a competent professional, do some math on it, and then ultimately decide what you and your spouse are comfortable with. Yeah, if you go home, you talk to your spouse and say, hey, I know he recommended we need $1 million, but I'm comfortable with 700,000. At the end of the day, it's your financial plan, it's your life. If that's what you two agree on, yeah, that's fine. So I think that's good. So this conversation is funny because I think that a lot of times clients with young children come in and they really want to talk about college planning, which is where our conversation started.
Yeah.
And then we segue it to another topic that I think we both agree is more important.
Yeah.
And that's how the planning meetings go with the clients also. That we start off with college, then we uncover all these other things we need to talk about, and now we're going to make our way back to college. So once we have, again, people listening to this, you want to have your life insurance figured out, your own retirement contributions figured out. If those two things are in a great place, now we're ready to talk about college, because according to the USA Today, a 2024 graduate had on average $37,000 of federal student loan debt, plus another $40,000 of private student loan debt. Between both sources, we're close to $80,000 of student loan debt for a graduate in 2024. If you've got young kids, you're probably projecting out to 2040-ish. So numbers are going to change. Those are scary numbers. So what can we do to help our clients hopefully be in a better spot when their kids do go to college?
What a question.
What a question. That's a short answer, right?
There's a lot of different ways we can go about starting to talk about this. I think looking at the numbers you just shared, we were talking right before we started recording too about some of the projected tuition rates that are out there. So one of the local private colleges here is currently $60,000 a year. And if we use an inflation rate and look at what that could be in 18 years, it was a little over 100,000 just for 1 year. State college, again, you're talking about almost doubling that in an 18-year period. That's quite a bit. Looking at our budget and trying to prioritize where all these things are going to be. In my experience, again, we work with people in all different phases, but specifically talking to a lot of young families, that that example you shared earlier, a couple $100,000 a year in that middle class range, that's a lot of people we work with. And it's very difficult for the average family to save for their own retirement, then save for their kids' college. We haven't even talked about
pay for their life insurance.
Pay for their life insurance. We haven't even talked about like childcare, daycare costs, and things like that. So I think one of the things I would start to say is let's start to take the pressure off a little bit, right? I don't know as if 100% of college is going to be realistic for most people, which is okay. What I, again, would start to focus on is what room do we have in our budget? And let's just start getting something going. If it's $50 a month that we need to start to go, great. If we can do a little bit more, if it's $200 a month, that's awesome. Things will always change over time.
Yeah, and I think that's the same advice I would give to maybe a young person who's just starting to save for retirement. Is you don't go into your first job and start maxing out your 401k. Like you pick a dollar amount that's really comfortable. And same thing's true for college. If it's $50 a month is a good spot to start, and then every year you get in the habit of increasing gradually. Maybe you go from 50 to 75, which doesn't feel like a big jump, and then 75 to 100, and then all of a sudden by the time the kid's 10 years old, you're saving a good amount, and hopefully that helps. The goal isn't to pay for all of college. The goal is to have something set aside that can put you in a better position.
And again, just for the listeners, this might help to conceptualize this, right? So if we, just using that example, a private college costs over $100,000 in future, that it would be in 18 years. If we started saving from zero today, it would, assume we get about an 8% rate of return, which I would say is pretty average, it's going to take over $10,000 a year of saving, which is a little under $1,000 a month, to hit that goal. For some people, that might be realistic. For a lot of people, it's not, especially with all the other things they have going on.
Well, yeah, and one of those is childcare, which I got a number for that too. But the average cost of childcare, according to care.com, which seems like a credible source, is about $2,400 a month in Rochester. Does that seem right to you? I don't have kids, but that seems...
It depends. If your kids are in full-time daycare, the going rate for a full-time daycare, like 5 days a week right now, is like $350, $400 a week. So if you have more than one child that's in daycare, those numbers are actually very realistic.
So maybe that's high for one child, but it's still, if you have 2 or 3 kids in daycare and you're an average earner, that's, for anybody, that's a big chunk of money.
Totally.
So some things. So you got to pay for childcare, save for your own retirement, pay for your life insurance policy, and then you got to find money to save into some kind of college fund. So let's skip ahead to that for time's sake. Let's say I do want to put $100 a month towards something. We got a few options, right? We have a 529 plan, we have the Roth IRA. We could use just a non-qualified taxable account. What do you think that parents should know about those 3 options? Or is there a 4th option you're thinking of?
There are 4th options in there. I don't know. We can go into it if we really need to. But I think those 3 options you mentioned are probably going to work the best for most people. So number one, I would start with is the 529. A lot of people have heard of this type of account. It really is a college savings account. So you're able to save on a tax preferred basis. So you contribute money into it. It can get invested and grow, and it will grow tax free. And the money will actually come out tax free, assuming it's used for higher education expenses. So think of it as like a Roth IRA, really designed for college specifically. So it's the best way tax-wise to save for college. There's no doubt about that.
Yeah, and the knock on that has always been like, you're earmarking money for college, so if they don't go to college, what do I do with this money? But recently some new legislation came through that makes it a little bit more flexible, so you can actually convert part of it to a Roth for your child down the road if they don't go to college. And they've really brought in the definition of higher education enough that it's not just your traditional 4-year university. It can be vocational schools. It can be cosmetology school. It can be a lot of different things. So unless you're talking about tucking away hundreds of thousands of dollars into this, if you're like most people and your account's going to have a $10,000 balance when they graduate high school, you're going to be okay. You'll find something to spend $10,000 on that meets the definition of higher education. So I think people shouldn't shy away from those as much as possible. But if they do shy away from it, what are the other options? Good plug.
I think the next, if we're looking exclusively for college, or even if, again, with that new legislation, that's some huge flexibility that didn't used to exist, I think that is a natural first step to look. We talk to a lot of people too that want to save for their kids' future, but not necessarily their kids' college. Maybe the goal is just for college, but they really are uncomfortable with the idea of the 529 being really just more for higher education expenses. So the taxable brokerage account is, in my opinion, step number 2, or account number 2 that you could start to look at, because it's an account that a parent would set up in their name, so they own and maintain control of it. You can contribute money to it, again, on an after-tax basis. You're not going to get the same tax benefits as a 529, but you're effectively trading that for full flexibility. So you can contribute as much as you want to it, and the money can be used for any purpose down the line. And again, it's an account in the parent's name, so they're going to maintain full access to it. I often use the examples of, what if you want to help your son or daughter, help them buy their first home? What if you want to help them buy a car, maybe start a business? That account is going to be really good for that, because it's not going to be necessarily tied up for higher education expenses or anything else. So you're effectively able to use the money for any type of purpose.
I think that's good advice for anybody too. We talk about this a lot, but having that taxable non-qualified account set up. And I think one of the mistakes we make in financial planning, and it's a good thing, right? We think about goals and saving for specific goals, but it's not always a specific. The things you need money for aren't always predictable, right? It's easy to say, I need money for retirement, I need money for college, but there's nothing wrong with tucking a little bit of money into something where there's no restrictions around it. So if something comes up in 5 years or in 30 years, you've got money that isn't wrapped up in a retirement account that you can't have access to. So I think,
there really is something to be said about the flexibility that it provides.
I think
for sure.
We know that things aren't going to work out exactly the way that we're planning, right? That's one of the parts of financial planning is as soon as you have a financial plan, it's almost certainly wrong because something will change. So,
we need to make adjustments over time.
It's like your emergency fund. It's there for a reason.
Yeah.
All right, we're getting to the end of our time. Is there anything else that you want to make sure we cover?
One thing that I do want to spend a little bit of time on is the child care planning. Okay. We could just talk about it for a couple minutes, just because this is really a big issue for a lot of young families. And I know that's what we're speaking to here, because it is extremely expensive. These costs are temporary, even though it really might be painful right now in the moment. But these things eventually will go away once kids get into grade school. But I would say really start to deep dive your options, right? There's definitely alternative ways to think about planning for childcare. Again, if you're fortunate enough to have family in the area, a grandparent who can step in for help. There's nannies and babysitters you can hire. So you don't necessarily need to go down the, full-blown daycare route. And I think a lot of people know that. And what I would want to make sure that they're mindful of are a few ways that can help them save money through those costs, right? There's a few tax credits and an account out there. I just want to make sure people are aware of. So the child tax credit is probably the number one. For each child you have, you can get a $2,000 tax credit. So that's huge. You want to make sure you're taking advantage of that.
That's why you keep having kids, right?
Yeah.
Yeah.
Keep paying less in taxes. Yeah.
Smart.
Eventually we'll get that number down, right?
All right. I got to work on that.
Yeah. So there's that. And then not to be confused with the Dependent Care tax credit, which works a little bit differently, but basically you can claim, the max is for up to two. You get up to $3,000 times two. So effectively $6,000 is what you can use as a credit. It's not the same as the tax credit though, because you can claim, it's depend on your income, but basically for a lot of people we're talking to, they're going to be effectively at 20% of that $6,000. And that's, even if you have more kids, the cap is still $6,000, unfortunately. If you have 2 kids and you're paying childcare expenses, there's that tax credit effectively could get you about $2,000 off. So that's another one you want to be taking advantage of. And then there's something out there called a Dependent Care FSA. So a lot of people have heard of it. HSA, a regular FSA. There's an FSA specifically for dependents where you can save pre-tax. The money has to be used in the year. So I would definitely check with your employer to see if they offer those. But it's a great way to save on a pre-tax basis. Then all that money can be used for childcare expenses, daycare expenses in that current year. It is pretty much a use it or lose it. So those funds won't be able to roll over. Right. But those are 3 kind of tax focused items that you want to make sure you're aware of.
Yeah, from a tax planning perspective, that's a huge savings.
And they can help you save money. That's the goal, right? Is these things are expensive. So if we can find ways to help offset that bill a little bit, then we're going to try and do that.
Sure, that offsets the $2,300 or $2,400 a month for daycare. If you're in that situation, that definitely helps. All right, a couple more numbers, and then we're going to wrap it up. So we didn't say it explicitly, but the child tax credit is $2,000 per year. Or maybe you did say that.
Yeah,
you did say that. So never mind. The other number I had written down here was, I was curious about this because you hear a lot of people talk about how much it costs to raise a child.
Yeah.
And I've seen the number $1 million thrown around for my entire life, and I want to know if that was right. So I looked it up, and I don't know if this is perfect. I'm sure there's different sources, but the Institute for Family Studies, again, sounds credible. Never heard of them before today, but they sound very credible. They say the cost of raising a child is about $233,000 a year, or $233,000 total from 0 to 18. They do say in the fine print that does not include the cost of college. So they're looking at daycare, housing, food. I don't know if that's right, but I thought it was an interesting number. What's your first impression of that?
My first impression is it's probably a little low if you divide it by 18, because again, you have the daycare expense, food is going to be a big thing, but then a lot of, as kids get into sports and travels, all the equipment you got to buy depending on the sports you have. You played hockey, so you know what that's all about.
Yeah,
right?
It's not cheap.
Yeah, it's not cheap. So all those things, I throw it in, but yeah, it
comes out to be a little bit more than $10,000 a year, which
that seems a little low.
It seems low to me, but that's what the number said.
Yeah.
Okay, so it's always a little awkward to end a podcast, so we're just going to cut it off. But Nick, thank you for being here. I think this is very helpful to people, and talk soon.
Thanks, Alex. Sure. Enjoyed it.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.